All right, let's talk about Diamondback Energy's fourth quarter 2025 earnings. This was a classic tale of two cities kind of quarter. There was this big, scary headline number that looked pretty alarming, but underneath it all, there's a completely different story, one that points to a much, much stronger future. So let's just dive right in and look at the core conflict that had the market doing a complete double take. And here it is. This is the conflict in a nutshell. On one hand, you've got this eye-watering $1.46 billion GAAP loss. Now, that was mostly from non-cash impairments, but still, it's a huge number. But then you look at the other side of the coin, and the company's operational engine was just humming, throwing off a full $1 billion in free cash flow. This is exactly why everyone was scratching their heads.
Okay, so first things first, let's get grounded in the scorecard. We're going to break down the key numbers and see exactly how Diamondback, and you know them by their ticker, FANG, actually stacked up against what Wall Street was expecting.
Now, what's really interesting here is the split decision we got. Adjusted earnings per share, that came in at $1.74, missing the street's guess by about 14 cents. But look at the top line. Revenue of $3.38 billion beat estimates by a pretty healthy $230 million. So right out of the gate, you're getting these mixed signals.
But, as we hinted at before, that earnings miss really isn't where the action is. The real story, the one that tells you about the true health of the business, it's all about the cash this company is generating, and more importantly, what management is doing with all that cash.
Just take a second and let this number sink in. $1 billion. That is the amount of free cash flow Diamondback cranked out in just a single quarter. This is that engine number we were talking about. It's what powers everything else, paying down debt, and of course, returning cash to shareholders. And this just says it all about management's confidence. I mean, think about it. Despite that noisy GAAP loss and the earnings miss, they went ahead and raised the base dividend by 5%. It's now at $4.20 per share annually. Actions always speak louder than words, right? Well, this action is screaming that the business is fundamentally strong. So, with the numbers all laid out, let's pivot a little bit to the strategic story we heard on the earnings call. And honestly, if you listened to that call, it was completely dominated by one single topic. This massive new resource they've been quietly building up. And there you have it, straight from the CEO, Case Van Hof. The call was basically a coming out party for their position in the Barnett shale. He didn't just frame it as some new asset. He was clear that this is a crucial piece of their long-term story and a major driver for their future. So just for some quick context, the Barnett is this deeper, historically more gassy formation right there in the Permian. What Diamondback has done is piece together a huge position and then apply all the modern drilling and completion techniques to unlock what they think is a top-tier resource, literally in their own backyard. This is all about replenishing their inventory for the long haul. Now, here's the most important part. How do they make this thing economic? I mean, the rock is good, but the first few wells were expensive. Well, management laid out a super clear 3-step playbook to attack those costs. First, move from single wells to big multi-well pads. Second, use these hyper-efficient silo-frac techniques. And third, drill much longer wells. We're talking over 15,000 feet. So what's the goal of all this? A 20% reduction in well costs. That's the magic number. Okay, so that's the company's story, that's their playbook. Now, let's flip it around and look at the investor takeaway. How did the market actually react to all this? And what's the bigger picture we need to be thinking about? Well, when you look at the performance over the last 3 months, something pretty interesting pops out. FANG is up a really solid 13%, absolutely crushing the broader market. But it's actually lagging its energy peers in the XLE ETF. And what that suggests to me is that the market is still kind of trying to digest this new, more complicated story, and maybe hasn't fully bought into that Barnett upside just yet. It's also really important to pick up on management's tone during the call. They kept using this yellow light analogy for the economy and for commodity prices. That caution is what's framing their whole 2026 plan, which, by the way, keeps oil production pretty much flat. They are not chasing growth in this kind of environment. And this slide right here, this really just crystallizes the whole disconnect. You've got management who spent the entire call talking up the long-term, massive potential of the Barnett, but the market's immediate reaction? It was all choppy and tied to the near-term stuff, that earnings miss and worries about commodity prices. This divergence is really the key to understanding the stock right now. So all of that brings us to the bottom line. Where does the stock go from here? And how should we be thinking about the next quarter's results? This is the next call.
This is the question every single investor is asking themselves. After a really complex report like this one, what is the trade? How do you position yourself for the next time they report earnings?
All right, here's our call. Next quarter, don't go looking for some huge production beat. That's not going to be the story. The story is going to be all about execution. Specifically, them showing proof that they're actually hitting those cost reduction targets in the Barnett. Because of that, we think the stock is probably going to trade in a range, as the market basically sits in wait-and-see mode. So our rating is market perform. The long-term upside here is huge, for sure, but that near-term execution risk keeps it from being an outperform, at least for now.
And look, if you only take away one single thing from this whole breakdown, please make it this question. The entire bull case for the stock hinges on their ability to turn the Barnett into a manufacturing-style operation and drive down those costs by that 20% target. So watch every single data point you can find on their well costs, because that is the catalyst that will unlock the next big move for the stock.
This is not financial advice.